Everyone remembers the crash of 1929, but almost no one understands what the final hours felt like inside a system silently preparing to break. People often imagine that the 1929 collapse arrived like a lightning strike, sudden, shocking, completely unexpected. But the truth is far more unsettling. The warning signs were everywhere, flashing for years, visible to anyone who cared to look. Yet the country still marched toward disaster, confident that nothing could go wrong. The 1920s had reshaped America into something the world had never seen before, a nation where the stock market appeared to defy gravity. Prices rose with such consistency that doubt itself became unfashionable. Questioning the boom was treated like questioning progress. And when an entire population attaches its identity to the idea that wealth can only move upward, the system begins to warp beneath the surface. After World War I, America was bursting with energy and money. Europe was exhausted, but the US was thriving. Factories expanded, innovation accelerated, and consumer culture exploded. Cars, radios, appliances, products once considered luxuries became symbols of the average American lifestyle. Production boomed, wages grew, and optimism soaked the country. But alongside that genuine growth, something dangerous was swelling even faster: speculation. Not investing, speculation. By the late 1920s, the fantasy of easy wealth had drowned out the reality of how fragile the system truly was. The stock market turned into a national obsession. Millions of people bought shares, but most weren't using savings, they were using borrowed money. Margin buying became the fuel of the era. With just a small down payment, anyone could control huge positions in the market. It felt like magic: a pocketful of dollars could be stretched into a fortune. But it was only possible as long as stock prices continued rising. This leverage brought ordinary people into extraordinary financial danger. From barbers to shop owners to young office workers, Americans jumped into markets they didn't understand. They weren't studying companies, they were betting on the idea that tomorrow will always be higher, and as long as new money kept coming in, the illusion held. By 1929, the fantasy had fully eclipsed reality. Stock prices no longer reflected business performance. Many stocks offered lower returns than basic bank accounts, yet people kept buying because everyone else was buying. Skeptics were mocked, fired, or ignored. In every bubble, there comes a moment when caution sounds like foolishness, and America had reached that moment. Even the Federal Reserve sensed something was wrong. But with political pressure mounting and the boom fueling national pride, the Fed hesitated to tighten policy. Cheap credit kept feeding the fire. The bubble inflated beyond reason. By late summer, the unease was becoming harder to ignore. Margin debt was astronomical. The real economy, manufacturing, sales, industrial output, had begun to cool. But the markets still soared, disconnected from the world that supported them. It was like watching a shadow grow larger even as the light that cast it faded. The tremors began in September. A sudden sell-off spooked investors, but when prices rebounded, people took it as proof that the system was unbreakable. That false sense of safety only deepened the trap. In October, the mask finally slipped. The decline started gradually, then intensified. By October 24th, later called Black Thursday, the panic burst into the open. Selling became chaotic. Brokers were overwhelmed, phones jammed, ticker machines hopelessly behind. People didn't know what prices they were selling at until hours later, and by then everything was worse. Margin calls hit like shocks of electricity. When borrowers couldn't add more money, their positions were liquidated at the worst possible prices. And each forced sale triggered more forced sales. The same leverage that pushed prices up now pulled them down. The weekend brought no comfort. America felt an invisible pressure tightening. Everyone sensed Monday would be worse, and they were right. October 28th, Black Monday, crushed the illusion completely. Millions of shares traded in a frenzy. Prices collapsed. Fortunes evaporated in a single afternoon. Brokerage firms failed. Banks teetered. The confidence that had inflated a decade-long bubble was gone, and with it the entire financial structure began to fall. People who had borrowed to invest weren't just wiped out. They were left owing money they could never repay. Bank deposits were in danger. Businesses faced credit shortages. Jobs disappeared. Fear spread faster than the selling itself. What followed, the Great Depression, wasn't just a market crash. It was the unraveling of an economic era built more on belief than on reality. The tragedy is not that people didn't see it coming. Some did. The tragedy is that those voices were drowned out by greed, optimism, and the irresistible sound of fast money. History recorded 1929 not as an unforeseeable disaster, but as a warning. A warning about what happens when speculation replaces substance and when confidence becomes the only thing holding the system together. Whether we learn from that warning is a question every generation must answer for itself.